This webcast addresses indirect tax function effectiveness and sets out the why, what, and how of managing an effective indirect tax function. According to Big Four surveys, the related control mechanisms are still inadequate. Simply put, indirect tax needs to be managed because the VAT throughput increases due to increased VAT rates globally. At multinational companies, we are easily talking about amounts of over 5 billion euros of VAT flowing through the books. An error in the accounts leads to major additional tax assessments and substantial penalties. VAT errors, as it is in transactional tax, impact profit margins negatively and could, beside tax risks, result in commercial and reputational risks as well. Tax authorities, due to technological innovations, have become increasingly better in executing their tax audit. The probability that the tax authorities will issue additional assessments and penalties in the near future because errors in indirect tax are detected increases by the day. Beside the why, it is important to know what needs to be managed within an organization. For change of roles and responsibilities, governance and mandate, involvement of senior management is essential. From benchmark studies, it follows that indirect tax is low on the priority list of senior management. The question then becomes what approaches and optimal practice tools are available to change that mindset and achieve the indirect tax objectives. A starting point in increasing indirect tax function effectiveness is to set clear and realistic objectives. Is being fully VAT compliant a realistic goal? An answer will be given. It is important that you understand the business model, the absolute amount involved, the VAT complexity, and the impact of change. That means understanding the key numbers and thus the VAT numbers under management. These are impressive enough to get the proper attention of senior management. In this example, the VAT number, excluding the bad debts and realized savings that needs to be managed, exceed at least 3.6 billion euro. An error has a direct impact on EBITDA, which is an important business KPI. A mistake of 1% impacts shareholders' value. This simple table shows how important it is to manage VAT. There are a couple of elements that need to be considered to determine the materiality of VAT risks. Using absolute amounts is the way a business control framework sets up a risk-based approach. However, a VAT control framework differentiates, as it is not only about paying the right amount of tax, but also about avoiding risks that impact the reputation of the company. This slide shows an overview of some risks relating to the company's reputation and potential impact for various stakeholders such as vendor and customers, but as well tax authorities, external auditors, and shareholders. In practice, measuring risks is often based on the balance between output VAT and input VAT and not on the total amount of VAT throughput, the earlier mentioned VAT number under management. The reasoning behind is that VAT is considered typically cost neutral for most businesses, a cash in and cash out scenario. A wrong perception, as every indirect tax function knows that deductible input VAT and liable output VAT have to be managed separately to avoid substantial VAT assessments, penalties, and interest payments. Besides that, VT neutrality has to be earned and is not a given fact. As we see in our daily practice, often no VT measurable goals are visible to the CFO, and a wrong perception exists about VT numbers on the management. As earlier shown, a mistake of 1% can be material and impact shareholders' value. That is an important business KPI of the CFO. The surveys of the Big Four are clear. We are talking about extremely large amounts of money that lack appropriate control. But because KPIs have never been developed for this particular purpose, the risks remain outside the CFO's field of view. CFOs focus according to these surveys more on direct tax than indirect tax. This is interesting, as from a tax revenue perspective, the current trend is a shift from direct tax to indirect tax by decreasing direct tax rates and increasing VAT rates. The indirect tax function often reports to the head of tax, who in turn reports to the CFO. The head of tax is responsible for all taxes in the company, but it appears as well that his main focus is on direct tax. This is one of the reasons that hardly any KPIs are determined for VAT, and the CFO almost exclusively attends to direct tax regarding tax risks. However, in order for any structural change to increase the effectiveness of the indirect tax function to be fruitful, both the formal support and active involvement of senior management is required. As a follow-up of the VT throughput exercise, statistical sampling could be used to measure the company's current performance. Sampling has the added benefit that the exact amount of any tax assessment by the tax authorities can be calculated. The result could be used to get indirect taxes higher on the priority list, since managing of material risks that are quantified falls within the KPIs of the CFO. For a root cause analysis, the following question should be asked in order to seek to understand what caused the outcome. How did the result happen? Why did they happen? What specifically caused them to happen? A root cause analysis is normally started via data collection and data analysis, or EP review and a clear understanding of the current processes and controls. Understanding the root cause is the first step to controlling outcomes. From a savings perspective, you want to know how to make them happen again. From a risk perspective, you surely want to know how to prevent them the next time. Setting realistic objectives is the starting point for any successful change effort. What is realistic? Let me explain via an example. Is being fully VT compliant a realistic goal? A quote from a survey. In our experience, the majority of multinationals strive for full compliance and they incur considerable costs in seeking to meet their VAT obligations around the world. Is that realistic? Effectiveness is the degree to which an organization achieves the objectives. When is effectiveness achieved? For the tax function, this is if all risks are managed and opportunities spotted and implemented. Efficiency refers to the extent to which time, effort, or cost is well used for achieving the objectives. As indirect tax resources are normally scarce, it is important that the available time is used in the most efficient and effective way. Beside the fact that managing all risks is cost inefficient, it will have a negative impact on efficiency beyond indirect tax. For example, time spent by the finance department on VAT matters. It is about making the right choices. In order to allocate resources to risk and cost savings areas that matter, the level of risk appetite of the company has to be determined. This facilitates prioritization in the deployment of resources. Having defined acceptable levels of risk leads to resources not having to spend time on further reducing risks that are already at an acceptable level. Most of our time is spent on high risk areas. The next slides contain templates that could support you in setting realistic objectives. Assume that the tax function of a company should work under the same market principles as tax advisors, and that the in-house customers are senior management, finance, procurement, IT, logistics, internal audit, HR, legal, etc. Customer satisfaction is achieved by managing the expectations and relationships of internal customers, tax authorities, external auditors, and other stakeholders. First is to determine the requirements of client satisfaction of senior management, as they consider indirect tax of a lower priority than the indirect tax function generally does. Is the root cause misinterpretation or not understanding and speaking the same language? The next step to achieve mutual understanding is to get agreement with senior management at the level of indirect tax risk appetite of the company in the worst case scenario. If you know the risk appetite, you have to identify the lowest performing indirect tax processes that have the most direct impact on the company's business objectives. Short problem statements for the gaps found should be written. They should include an estimate of savings or the amount of hours currently lost due to rework. Identify a problem, measure its magnitude, determine why the problem exists, and generate a set of solutions to ensure that the problem goes away. These statements can subsequently be prioritized and validated with senior management. Various solutions are presented with cost-benefit analysis, so a constructive discussion with senior management can be held about what is needed to close these gaps. For example, about budget and or resources needed or necessary for change of systems, processes, and controls. In the worst case, the gaps will not be closed, but at least you have achieved mutual awareness and hopefully responsibility. However, if the problem is material and addressed in the right way, it will more than likely be dealt with accordingly, because it has now become a mutual responsibility. The indirect tax department needs to consist of the right number of tax personnel and the right level of skills and capabilities to be successful. The following also needs to be assessed to test whether objectives set can actually be realized. Are the right competencies available? Is enough skilled tax personnel available? Is training and specialization available? Is there access to external expertise in a timely manner? How is attracting and retaining managed? Is there sufficient budget available to realize objectives, considering the tasks and responsibilities assigned to the indirect tax function? This template can be used for such an assessment. Phoenix Consulting is a company led by 6 partners and a team of around 30 employees. Our main business focus is to optimize SAP from a tax, financial, and control perspective. We have offices in Amsterdam, Berlin, and Cologne. We hope you enjoyed this webcast and hope to hear from you soon.